So here we go, man. We're going to be talking about construction loans with you, and you've got a very specific case. And yeah, it's going to be a very open conversation about how to build homes from here. And it sounds like you really got it set up. So let's go ahead and we're going to talk about how to build a home and what are your options when it comes to building your dream home. And this is going to be very conversational, so you can interrupt at any point in time. There's no set boundaries when it comes to this, unless you're asking me about my hair. Then I have to stop the questions there. Other than that, we'll be
All right.
going.
All right.
Okay.
All right.
All right. So as far as options, when you come to building a home, you really have two really big options that you can pick from when it comes to building a home. The most common one that people are aware of is the turnkey option. And in this turnkey option, it's kind of like the builder already owns the lot. They they're already either under construction or about to start under construction. A lot of subdivisions and neighborhoods are like this, and they'll build the home for you on the lot that they own. Typically, you have to give them a deposit, an earnest money deposit, which they'll use towards the construction on the land and also the house, and that's between 5 and 10% once it goes under contract. But the builder in this case, in the turnkey option, is really going to be responsible for the construction, for the interest, for everything regarding this home. And so there's little risk to you, but there is additional cost that gets built in because the builder is carrying the cost and he's making the payments and paying the interest at the same point in time, which then gets added to your bill later. Now, you don't get to see it because turnkey wise, they've already priced that in as far as timelines. They kind of have a good idea what the work's going to be. And then there are other things that they kind of build into this. Now, what we're really going to be talking about mainly today is we're going to be talking about the construction option where this is called a construction-to-perm, where in essence, kind of like in your case, Bernard, we're talking about the land that you already own, that you have, that you bought from family, that you're going to be building your own place on, and literally you already own it. And the great thing about that is because you already own it, you can use that as collateral, meaning the down payment.
Mhm.
And that really cuts down how much cash you're going to have to bring in, really cuts down how much extra cash and effort you have to bring in, because in essence, when it's all said and done, that gets used towards the down payment and the closing costs. And it's almost like a refinance instead of a purchase because you already own the land. Okay. Now you are already in the process of picking a builder to work with. And once you've picked a builder to work with, then once you close on the loan, they'll just go ahead and get started. Now, there are some very specific steps that we go through when you're picking a builder. And in large part, it's because most builders are fantastic at their craft, but they're not always very good at paperwork. And they're not always very good at making sure that every T is crossed and every I is dotted. And so we have a second set of eyes that we help you with when it comes to that to make sure that they're going to be around longer than the warranty. In other words, that they're not going to disappear. And unfortunately, there are some horror stories out there of people who have picked builders who were fantastic at their craft, terrible at their paperwork, terrible at managing money. And unfortunately, they overspent their budget and then were not able to complete the house. And the builder literally didn't have another penny to put into it. And it created all sorts of problems. This construction-to-perm loan is really designed to help get around that and really to get you past that. And so we're going to talk about, finding a lot, which in this case you already have it, picking a builder and how to work with them, get the construction loan, and then once that home is complete, we're going to talk about what happens with the construction loan itself. So really the construction process is the first step is finding the land and finding the lot to buy and build on. In your case, it sounds like you have fantastic property in rural Alabama, right on the water, and it's going to be a really good setup for you. Now, the programs that we do have available as far as loan programs is these are the most common ones that are available on the market. I would say the most popular one is the one up towards the top, just because it tends to be a whole lot more flexible. The conventional one-time close, we do have FHA, NVA. The VA one has changed slightly as far as down payment requirements. And then the jumbo, which is for loan amounts well up into the 800 mark. If you're going down that path, that's a great one to go, but that one does require a two-time close instead of a one-time close, which I'll define a little bit more here in a second. And so it really is, these are the main programs. Now, all of these that you're seeing right here, the conventional ones are going to be the ones that have the better terms long term. Now, short term, the FHA and the VA will be really. Are you a veteran, by the way?
I'm not. Both of my dad and granddad, Air
Okay.
Force, but they taught me out of it. I'll put it that way.
I bet. Yeah. I actually consider it myself. I was talked out of it myself. But
Yeah.
yeah. But anyway, the conventional loan is probably one of the better long-term loans. It does
Hmm.
have a little bit more requirements up front, minimum of that 5% down. But more than that, it's really considered to be a really good, it's
Hmm.
considered to be a great program to help you get in the door. Uh, the construction process that we're going to be going through really with you is once you've identified the lot and the lot that you already have on hand, now the next thing is to get the builder. Now the builder has to put together some budgets for you. And the budgets are really designed to provide you with safety. Now, the
Hmm.
more detailed these budgets are, I have found that there is safety in a really tight budget where you have really defined everything in the house. And so here's what I mean by that. There are a lot of things in a house in a budget that builders will kind of lump into what they call allowances.
Hmm.
And they'll say, well, you have $40,000 allowance for the kitchen. Okay, well, that's great. Does that include the appliances and the countertops and the faucets and the sinks and all the pieces of the pie, the backsplash, everything? Or is that just the cabinets and countertops? And the reason I say that is having worked for a builder, I worked for a builder for almost a decade.
Hmm.
Where we made our money was in the upgrades. We made our money in the upgrades because, in essence, we would put a very basic faucet in that literally very few people ever selected. A 60 to $100 faucet would be the bathroom standard faucet, which very few people ever wanted. And they would always upgrade that to something else. Well, when they upgrade it, we have a chance to change our profit margin by adding money to that. And that's what we would do. And sometimes they'll give you a credit if the faucet that was the base faucet was $100, they'd give you credit for $50 of that. And then you'd have to pay another $50 plus the difference on the faucet. And so now the profit margins start changing very quickly based off of that. So understanding what your budgets are with the builder is going to be very important. I would encourage you to define these budgets a little further and maybe even find out who he uses for selections so that you can go in and start picking some of these things out. And what I mean by that is, there is a base thermofoil kitchen cabinet that you can get from Merillat that is very inexpensive. But if you go into KraftMaid and you get a painted cabinet, now you've just changed the profile of your cabinetry from an apartment grade cabinet to a very upper range, nice looking cabinet. Nothing wrong with either one, depending on what kind of look you're going for. And if your budget doesn't allow for the upper grade one, you need to make sure that you define that early because in the kitchen, we tended to see upgrades and in the homes that if we gave them a $40,000 budget, we usually saw them upgrade by 10 to 15 to $20,000 just in the kitchen. And so those were places that I would highly encourage, dive in it a little bit deeper with the budget on the builder. Now, once you've gotten the budget to a place where you feel comfortable, tile is another place. Hardwood floors versus laminate, these are all big pieces to understand. Once you've gotten that budget to a really good place, the next place is to put in an application. Now, what we're going to do is we're going to take a look at the budget that the builder has given. We're going to couple it with the land. We're going to look at the loan to value based off of the land and the construction. And then literally, if you have more than 20%, or even more than 5%, you don't even have to put any money down. Most of it just comes right out of the budget from the land itself. And so it actually works very well in the application process. Now, in the application process, what we're going to be doing is we're going to be making sure more than just that you're credit worthy, that your credit, income, and assets support the loan. We're actually taking an application from the builder at the same point in time. Because, like I was saying off of this recording earlier, um, the builder is fantastic at building, but many times they're robbing Peter to pay Paul. And we want to make sure that they're not robbing Peter to pay Paul in your house because we want you to eventually move into it. And that's a really big deal because if you're at the point where you can't move into the house because the builder has overextended himself and he has to, number one, take his crews and go finish another job so he can get paid. Not only are you running into delays, which cost you money, but you also have the frustration of dealing with extras that you never intended to have in the first place. So when we're vetting and doing the application, we have to vet the builder too. And we're going to ask him for financials. And the financials are really to prove that he has the ability to sustain the projects that he currently has, as well as the projects that he is going to be working on with you. And it's really, we're not doing this to interfere with his budget. We're not interfering with his profit margin. We're just making sure from a safety standpoint that you're not going to lose your home if this guy doesn't perform. We're going to look at it from a standpoint of does his balance sheet show that it's going in the right direction? Are his taxes reflecting profit? So on and so forth. And it's really that's what it is. We're going to look at balance sheets, profit losses, and taxes just to verify that's going the right way. When we're done with that, then what we're going to do is we're going to put together a budget review, which is going to be done after that with a project review. And what we're going to do is we're going to have the builder define things. Builders are really good. Builders and remodelers are really good at saying, paint the walls. Okay, well, that's fantastic. Are you going to prime them first, or are you just going to paint them? And when you paint them, is it going to be a eggshell or is it going to be a semi-gloss? Because each one has a different cost associated with it. And so there are places that we're going to have them define that, and that's part of the budget review. Now, generally speaking, what we'll do in that process as well is we're going to add in there some contingency fees. And these contingency fees are to make sure that if you start digging for a foundation and all of a sudden somebody buried a 1957 Cadillac in there and it's half rusted out, we have to be able to dig that car out in order to be able to get the foundation in. And so it's a contingency fee for who knows what. Now, if you don't use that contingency when it's all said and done, then what we're going to do is we're going to credit it back to the principal, and then you can do a principal curtailment and reduce the payment as well. Once we've done that, then what we're going to go is to the next step, which is the project review. When we're doing the project review, we're going to be, in essence, making sure that the project makes sense and that the builder hasn't really gotten himself into trouble. And we're also going to be getting everybody to get agreement on what's happening with the draws, because the builder is not going to get paid every week. They're going to get paid off of construction milestones. And what that means is that if Friday rolls around and their next milestone is the foundation's going to be in, they're not getting paid unless the foundation's in. And so what's going to happen is that the builder has to give us a notice on Thursday. They can call and say, "Hey, Chris, just want to let you know the foundation will be finished by Thursday, by this weekend." Okay, so that means on Friday we can send out late in the day. We can send out the inspector. He will go out and take photos just to prove that the foundation has been finished. And then he'll do what's called a draw request. And then by the middle of the following week, the builder will have the money in his account for the draw that he's requested on the last one. Now, the reason why we want you to do the project review and we want you to sign off on the draws is for two reasons. One is it's protection for you because the builder then is pretty much on a timeline that if he doesn't meet that timeline, he's not going to get paid. Okay, so that's a benefit to you, but also the benefit is that from every time there's a draw, we have to pay an inspector to go out and make sure that the work has been completed. And as the work has been completed, what we have to do as well is that we have to do what's called a title drawdown, which is go down to the title courthouse and re-record the new lien for the money that has been dispersed from the next draw. Okay. So in doing so, it costs you money. And so we want to limit the amount of draws that the builder has to 6 to 9 draws over a 6 to 9 month construction time frame. And the builder can pick. He can pick when those are done. He can pick how they're done. He can pick the milestones, and you can agree with the builder on what those milestones are. And that's where there's safety to you, because if he hasn't met those milestones, then he's not entitled to submit for a draw. Okay. And it's pretty good once we do that. Now, the next phase, what we do with that is then we're going to lock the loan. We're going to get the loan locked in, and we're going to start reviewing the work and getting the file into underwriting. And then we're going to do the final builder and project acceptance. Now, we have a construction department that'll be looking at the builder on a separate track as we're looking at the loan itself. Then when we do the final underwrite, everything has been approved for the builder and everything has been approved for the loan, and you close on the property. In essence, you already own the land, so you're not doing anything like that, but you in essence close on the construction loan. And after that, that is when the construction process starts. And literally, it works very, very quickly, assuming that the builder has already, during the project acceptance phase, that the builder has already done a couple of these next steps, which is to, in other words, fine tune the blueprints and create the budget from the specs that we've had. And then once they sign on that, we sign the contract and everything moves forward at closing of the loan. Now, here's a couple things that the builder that we do have to do in the construction process is submit the builder product for approval. Here's kind of what that looks like. In the customer approval, we're going to be looking at credit, income, occupancy, assets, liability. With the builder, we want to make sure that he has a history of actually being able to do this kind of work. In other words, that he's not been a handyman and then all of a sudden he wants to build a house, because we can't really justify that he's got the ability to do it at that point. Now, it doesn't mean that he doesn't. He may have some in his history, but we want to get references, and we're going to get references of some of his contracts as well as some of his subcontractors. We want to make sure the subcontractors have been paid as well. And then after that, we get the project accepted and get all the worksheets and everything else that gets set up to be able to help you get through the process in timeline. Now, during the construction phase, we'll talk a little bit about the process. After the builder is approved and the project starts, and we get the underwriting done, the next phase is really the construction process as well. And so and this was part of the draw schedule that I was talking about, if the builder submits the draw through the app or the website on Monday, the inspection is ordered. Wednesday, they show up and they take a look and they get the lien waivers from the different people that are going to be paid on the project. And then they send it to you for a signature. And then after that, the builder on Friday, in essence, gets his money. So it takes a little bit of process for the money to happen. But what we want to make sure is that the material man and the subcontractors doing the work are not the last ones to get paid, but they're one of the first ones to get paid, because we just don't want any additional liens when it's all said and done. And if the builder can't provide those lien waivers, then we're going to have to hold that money back and pay those people directly, because we just want to make sure that when all this is done, that in essence, you're protected with the process. And that's really what that part of that construction process is. Now, once the construction is 100% complete, the loan will convert to a permanent mortgage. Now, we have within this, there's two different options depending on what you want to do it. There's the one-time close, and then there's a two-time close. The one-time close is the most popular, but it is what's called a closed loop loan. And with a closed loop loan, what that means is you can't add any additional funds to it. You pretty much are stuck with whatever it is. That's why the contingency fee that we talked about earlier is really such a big deal. Because if you don't have a contingency fee and there's an extra like a Cadillac in the foundation that you got to dig out, then you got to come out of pocket for that, because you haven't built that into the loan itself, or you don't have a contingency fee to cover that. Now, the construction process, once the construction process is complete, what we do is we're going to do a modification review. So in essence, when we're doing a one-time close, because traditionally there's two loans in a construction loan. The first loan is a construction loan, which is an interest-only adjustable rate mortgage based off of prime plus 1.5. And in essence, the way that that works is every month it adjusts based off of prime. Now, prime hasn't changed quite a bit at all recently. And so that's going to be pretty much stable throughout the construction process, but it is interest only. Now, the beauty of it is that we typically try to include what would typically traditionally be the 9 months of construction, the payments for that interest, we include that into the mortgage. That way you don't have to make payments out of pocket. And in essence, you don't have to be making a payment for your rent and a payment for the new house at the same time. And that's a huge deal, because otherwise it can feel like you're getting mobbed having to pay your rent or your current mortgage and the new mortgage at the same point in time, even though it might only be an interest one. So
That's phenomenal. Can I ask you another question about that? How does the underwriting go as far as rent as well? Is that excluded like on a pro forma basis as well? Because I mean that's kind of going away with the new home, right?
If it's rent, yes. If it's a mortgage, no.
That's right. That makes sense.
Yeah, if it's
Thank you.
rent, we look at it as a departing residence that is going to get terminated upon the new one.
All
So,
right, fantastic. Thank you.
need a drink there. All right. So then once the modification starts, they're going to have to recheck and make sure that you're still employed. They're going to have to recheck and make sure that things are going the way they should be and that you haven't been unemployed and that things are working in your favor still. Um, And the file gets reviewed. We get some updated documentation, which usually is an updated pay stub. Check with your employer to make sure you still have that going. And then what we do is we send the modification down to the title company to get it recorded down there. And so, in essence, what happens is that the interest only loan gets modified into a fully fixed 30-year traditional mortgage, kind of like the one you would have on a traditional setting when you're buying the home. And then it just goes down to title, you sign off on the modification, and then the loan gets sold um, to the local investor. Now, in the construction process, if once we get into the actual closing, pretty much we want them to start construction within 30 days. We have a team that will be helping in the process. That team works with a subcontractor called Land Gorilla. And what they do is they will, in essence, manage the construction draw process for us to make sure that it's all set up. When construction commences within 30 days, the modification check-in will go based off of the timeline. We really want to make sure that the contractor is pretty much wrapping up his stuff within that 6 to 9 month window. Because every month, if he misses his 6 to 9 month window, we can go as long as 12 months. We really want to know up front from the builder how long it's going to take him to build. Because, we have to lock the rate for that period of time because we don't want you getting into a situation like the one we got into recently with Epic Fury, where the rates went absolutely nutty the minute we went into Iran. Everybody got scared, rates got crazy, and all of a sudden people weren't qualifying for homes. And so we want to make sure that that doesn't happen. So we lock the rate in to make sure that you're covered.
Please explain to me the rate lock. So that's locking it for the perm period for qualification, or just
So
a little
when
more
you
about that.
when you close on the property, you're buying the home and you close on the
Hmm.
loan, we have a rate lock that happens that is for either 6 months, 9 months, or 12 months. Now, the rate is adjusted based off of 6 months, 9 months, or 12 months because there's more risk the further out you go. So what that
Hmm.
means is it may be 6.5 for 6 months out, but it might be 6 3/4, 9 months out, or 7%, 12 months out. Now you get a free float down right before closing. And so what that means is if the
Hmm.
rates have dropped from 7% down to 5.5, we're not going to keep you hostage at 7%. We're going to float you down to 5.5. Okay. But at the same point in time, you're protected from it going to 9%. Like just recently during Epic Fury, the rates were at 6.25, and literally overnight they went to 7%. And we had the people who had not locked in from 6.25 to 7% were now struggling to qualify for the same home that they would have qualified for at 6.25. And we just don't want that to happen. Okay. So that's part of what we're doing with this process and with modification lock-in. So as long as the builder meets his timeline of whatever he picks, 6 months, 9 months, 12 months, then as long as we close before he finishes construction before that timeline, and we can complete the modification within that timeline, everything works the way it's supposed to as far as the loan is concerned. Okay.
Yeah, okay. So let me ask you just one more about that. So you're floating at 1.5% over prime during construction.
Mhm.
What's the terminal rate there? Is it the 30-year rate,
Yeah,
or are you still
it's a
okay?
30 year. It's
Do
the
you have
30-year rate. The 30-year rate is what we're using,
uh-huh.
and we're adjusting it. There's a small adder for time that gets added in. So in other words, it's today's rate plus a small adder for time based off of the six
Hmm.
month, 9 month, or 12 month
Gotcha.
construction time frame.
Right. Do you have adjustable rates like SOFR or anything for the as an option for the permanent rate, or is it only the 30-year fixed?
Well, most people select the 30-year fixed because the ARM rate is harder to predict when it comes to that.
Hmm.
But we can, in the two-time close, if we go back to the larger, if you want more of an open loop loan, where in essence, and here's where we see open loop loans specifically. Jumbos tend to be very much more in that range because they're a much higher
Hmm.
price point, $1 million plus kind of piece. Now, in
Hmm.
the two loop loans like that, we can see the people refinancing instead of getting a modification. Now, the cost is two transactions. So you're
Right.
paying closing costs twice. That's why most
Right.
people prefer the try to plan it with a one-time close.
Hmm.
But that's where that opportunity comes in to get a slightly different setup for that and get an arm if that's what you want.
Yep. Makes sense. Thank you.
Okay. All right. So I'm going to do a real brief intro because we've talked about a lot of the stuff that already happens with construction. I'm just going to share a little bit about myself and what I do. And this is certainly me. And you can certainly join in the conversation on my YouTube channel if you'd like. The reason why I do these workshops and do these classes is very specifically because of what I do and how I do it. And the why I do it plays such a big role, much bigger role than what I do. And I'll share my story as to why cash flow plays an immense part of my life. And I've learned that cash flow really is one of the most important things a family can actually experience and understand. And I find that most families don't understand cash flow. Now, when I was growing up, I'll share a personal story. When I was growing up, we were very blue collar, which is a very nice way of saying poor. And I didn't even have a bed until I was like six. So I learned very quickly that financial institutions weren't built for people like me. I just learned. I learned that we did not understand cash flow. We did not understand credit. We did not understand liabilities. We did not understand that every time we used credit, we were borrowing from tomorrow's earnings. And we got ourselves into a lot of trouble. My parents really took a long time. But what we ended up having to do in order to rebuild and to understand and to be able to be more fit for financial institutions is we had to learn cash flow. In doing that, we had to first understand that we had to build up a little cushion so that we didn't have to rely on debt. And then we built from that and we started paying off and accelerating off the payments of our debts. Then we created liquidity, a lot of liquidity. In fact, so much liquidity that we paid our house off. And then my parents, they were very smart. They went and got another property and they repeated it. They paid it off and they turned those into rentals, which increased their cash flow. Now they're still very blue collar, but being very blue collar, they actually amassed quite a network and portfolio of real estate to where my dad just passed away last fall. My mom is still living. She's living entirely independent from the cash flow that she's learned to build through real estate and through also the pieces of life that we've worked through. So I work very, very exclusively and very hard to make sure that families understand the cash flow and that we're never setting them up for failure when it comes to buying a house or building a house in this case. Now, on my YouTube channel, you'll be able to see a lot of different things that I do and certainly have a lot of options when it comes to doing this. This month specifically, we're talking about building and development because we also have development loans to where we can help people develop pieces and tracts of land to where they can actually start being contractors and build subdivisions and sell homes as well. So if that's another conversation you'd like to do, more than happy to. Or if you have people that are interested in that conversation, certainly happy to do that as well. And that really just kind of comes back to this is I work by referral specifically because I find that I would rather do items like this than cold calling. So that's how I work when it comes to that. And so you're the backbone of my business, and anything I can do to serve you is certainly the most important part of my day. Now, we did a really high level overview of this, and I don't really want to take too much more of your time if I've answered a lot of the questions, but I certainly would go into more depth if there's something that you specifically would like to talk about when it comes to building or renovating, because this can be used also to renovate if that's something you're interested in. Any, all right. You all good? Any questions? Any comments?
No, that's really helpful.
Okay. All right, good. Well, thank you so much for that then. So I wish you the best as you're going into this, and we would certainly love the opportunity to help you with the construction loan if you need it.
Yeah, I've spoken to a couple of folks here. I saw a YouTube kind of tutorial with three folks from your department there, and I really like the outfit, and um, I really think I'll be reaching out as soon as I get a few more of those due diligence items knocked out.
Okay, well, we look forward to it. Look forward to talking to you very soon. I know that's going to be a fantastic build on your family land. So,
Yeah, yeah, we're looking forward to it. Everyone's excited.
all right, good. Well, have a great evening then. I'll let you get back to it, and it's been a pleasure.
Thank you, Chris. Take it
All right.
easy.
Thank you.
Bye now.
Bye-bye.